Hello and welcome to Money Unshackled News, the headlines. Fried chicken to double in price due to a shortage of grain and cooking oil from Ukraine. Money Unshackled call for peace. Energy bills on track to double and set to hit £2,500 in October. Unbelievably, this is good news as prior estimates were as high as £3,000 for typical use. The spring budget offers meagre help for struggling households, with the government's affinity with high taxes continuing despite the cost of living crisis. Motorists given insulting 5p cut in fuel duty, while VAT on fuel actually rises more than this. NI threshold hiked £3,000 to match income tax, but no reversal of planned 4-year frozen threshold and no reversal of health and social care levy.
Interest rates continue to be hiked as they are raised to 0.75%. Experts say they could reach 3.5%, piling on the pain for indebted homeowners. Global dividends hit a record high of $1.47 trillion in 2021, and 2022 is on track to be even better. John Lewis scraps never knowingly undersold price pledge as it was complete BS.
11 million households in the UK are in financial wealth poverty. And if the EU bans Russian oil, Rishi Sunak estimates the UK economy will be hit by up to £75 billion straight away.
There's been a lot happening in the last few weeks, so we've aggregated all the important money news to bring you the stuff that matters. Now, let's check it out.
As always, check out the offers page for free cash, free stocks and discounts to many investment services and apps at moneyunshackled.com. We're always updating the offers page with more goodies and bonuses, so if you've not visited in a while, check that out.
Let's kick off with the most horrifying money story that we've seen. No, we're not talking about surging petrol prices or energy bills. No, this is far worse. Fried chicken is set to double in price due to a shortage of grain and cooking oil from Ukraine, reports The Sun. It's also being reported that we could face smaller portion sizes.
The cost of feeding the chickens is one of the biggest factors in the price of poultry, and neighbouring countries such as Poland, who are major processors of poultry, are facing disruption. We're dismayed to report that your local chippy is under attack too. Ukraine also supplies more than 40% of the world's sunflower oil, used in hundreds of products including the batter on your fish and the oil the chips are fried in. Mr. Putin, sir, if you are watching, we apologise and surrender unconditionally. Please don't take our fried chicken.
Rising energy bills may not be breaking news, but much of the media focus has been on the cap hike coming in on the 1st of April. But since this was calculated, wholesale prices have gotten much worse, and we can now expect another mega increase in the cap in October.
Martin Lewis tweeted a glimmer of hope recently, if you can call it hope, by saying that bills are now only predicted to rise a further 29% instead of 50%. The cap is currently £1,277 per year, will rise to £1,971 per year, and in October is now predicted to hit £2,512, ridiculously high, but before this updated forecast, the thinking was that it was on track to hit nearly £3,000 per year.
With the price of energy skyrocketing, it makes the energy rebate loan thingy, masterfully created by Rishi Sunak, seem like a complete joke. Even more of a joke than what it was when it was first announced. As a reminder, energy bills will be lowered by £200 in October, but your bills will be artificially increased by £40 a year for 5 years thereafter. Rishi was banking on energy prices falling so that the extra 40 quids would cause less pain, but seemingly he has not planned for the more likely scenario of rising prices. With Russia now a pariah state and the whole of Europe desperately trying to find new suppliers of energy, prices are only going up in the foreseeable future. This will mean we will have the double pain of naturally rising prices plus having to pay back Rishi's mandatory energy loan.
In the spring budget, Rishi Sunak offers very little help to struggling households and continues to use smoke and mirrors to mask the true impact of new taxes, frozen thresholds and limited tax cuts. As always with politicians, it seems to be a case of giving with one hand but taking with the other. Fuel duty has been cut by 5p per litre for 12 months, which is the biggest cut ever, as the Chancellor likes to point out, but considering petrol at the pumps is up about 55p in recent months, That means that the government's coffers are taking an additional 9p per litre in VAT. So the real story is that the government is shamefully profiteering from our pain while telling us how generous they are.
Next, the national insurance threshold, which is the point you begin to pay NI contributions, is being raised by £3,000, so that it's now in line with income tax. The tax saving is worth over £330 a year and is the largest increase in a basic rate threshold ever. That's great. It will be a massive help to everyone, especially the lowest earners, and it will even help to simplify the tax system slightly. But there was no reversal of the 1.25% NI hike, or Health and Social Care Levy as the government has branded it, and there was also no reversal of the 4-year freeze to the income tax threshold. With inflation running rampant, hard-working British people will end up paying more tax in real terms.
Rishi also promised to cut the income tax rate from 20% to 19% by the end of the current parliament in 2024. I don't know about you, but we'll believe this when we see it. In the now infamous Tory election manifesto of just over 2 years ago, they promised to not raise the rate of national insurance, which of course they're doing in April, so distant future promises don't really count for much.
One positive from this budget was that there was no short-sighted windfall tax on oil companies, which some of the opposition were calling for. The UK needs to be welcoming to companies who wish to do business here. Punishing temporary success is the wrong message to be sending out, so Rishi made the right call on this. And there was no call from the opposition to help out the oil companies with a windfall rebate when energy firms were on their knees in 2020. We are disappointed that in a time of real danger, there was no additional spending announced for defence. In fact, our army is currently only 76,500 strong, and this is being reduced to 72,500 soldiers by 2025. For context, Russia's military is said to have 900,000 active troops and 2 million reservists.
Interest rates are being hiked. The US Federal Reserve approved the first interest rate hike in more than 3 years, raising the rate from 0.25% to 0.5%. A day later, the Bank of England raised rates from 0.5% to 0.75%.
Adjusting interest rates is one of the many ways the Bank of England tries to manage the UK economy. Raising rates helps to put a lid on inflation, and right now inflation is soaring. The bank expects inflation to rise to around 8% in the spring, and worryingly, it could go even higher. We think the Bank of England has no choice except to raise rates, but there are question marks about what impact they will have on inflation. The inflation problem is largely being driven by supply issues, first stemming from a response to COVID, and now the war in Ukraine.
After the world economy began to open up after the lockdowns, there was a sudden increase in demand as people wanted to start buying things again. But obtaining the goods, especially those imported from abroad, has proven difficult. Recently, I bought a new office desk from IKEA costing £100, and a week later the price was £130, a whopping 30% hike.
The Office for Budget Responsibility, the government's independent economic advisor, has suggested that interest rates could reach as high as 3.5%. All this is bad news for borrowers. Mortgages will become more expensive, and you'll feel this immediately if you're on a variable rate mortgage deal. For those on a fixed deal, you won't be affected straight away, but when it comes to looking for a new deal, you will find the rates much more expensive. We should also see the interest paid on savings go up slightly, which is good for ordinary people, but as investors, most of you guys will likely have the majority of your wealth invested in stocks. Rising interest rates generally translate into falling stock prices. Bad for existing portfolios, but potentially a decent buying opportunity.
There's been an awful lot of negative financial news recently, even more than usual, so let's correct that. Global dividends hit a record high of $1.47 trillion in 2021, and 2022 is on track to be even better, according to the latest Janus Henderson Global Dividend Index.
Global dividends surged by 16.8% to reach a new high of $1.47 trillion, with records broken in a number of countries, including the US, Australia, China, and Sweden. 90% of companies globally increased or held their dividends steady as banks and miners delivered 3/5 of the $212 billion increase in payouts. In the UK, dividends rose 44.3% in 2021, an increase of $28.9 billion. This was driven by record special dividends paid by the mining sector, which benefited from soaring commodity prices.
Interestingly, out of the thousands of companies in the world, the top 10 dividend payers paid 11.4% of the total, and the top 20 made up 16.7% of the total. For 2022, it's expected that global dividends will grow another 3.1% to reach a new record of $1.52 trillion. The big unknown for 2022, according to Janice Henderson, is what will happen to the mining sector. Iron ore prices are a significant driver of dividends, and despite iron ore prices recovering some lost ground recently, they are lower at present than during most of 2021.
Here's some news that will send shockwaves through the retail sector. Or maybe not. John Lewis has scrapped their never knowingly undersold price pledge, as it was complete BS. The promise, in theory, meant that John Lewis would match the price of like-for-like branded products if a customer pointed out they could find it cheaper elsewhere. Since the invention of the internet, they would have been more accurate to make their pledge never knowingly cheaper.
A third of households in Britain were spending more than their income before the coronavirus pandemic, according to figures from the ONS. Of these households, 46% had an insufficient financial buffer that would only cover their overspend for less than a year.
And for single people, the figures are worse. Of those who are of working age and who live alone, 57% spent more than their income. These people are typically able to cover the shortfall for an average of just 3 to 4 months.
There are 11 million households in the UK that are in financial wealth poverty. A household is in financial wealth poverty if, in the event of losing all their income, they have insufficient money to keep them above the income poverty line for 3 months. It is shocking statistics like this that really lays bare the financial struggles and desperate situation much of the UK population is in, a supposedly prosperous country with the 5th largest economy in the world, which makes this next news piece particularly frightening.
Rishi Sunak has said that if the EU has an immediate total ban on Russian oil, it will tip economies across Europe into recession, including the UK. He estimated it would result in a hit of between 70 and £75 billion to the British economy straight away, the equivalent of about 3% of gross domestic product.
What are the chances of a total EU ban? Well, you may consider it unlikely, considering Russia supplies 40% of the bloc's gas and a quarter of its crude oil. But despite this dependency, more than 100 MEPs signed a letter calling for an EU ban to kick in immediately. And in any case, Putin may unilaterally switch off the energy supply to Europe if he felt inclined to strike back against Western sanctions. It would hurt him economically, but then so have all his other moves in the war in Ukraine.
This isn't the first recession to be forecast, and it won't be the last. Nobody knows for sure when a recession will come, but there's no harm in being prepared. That means having a big household emergency fund on standby and trying to recession-proof your income.
Question of the day: what's worrying you more? Is it rising energy bills or the soaring price of fried chicken? Join the conversation in the comments below. Thanks for watching. On this channel we talk a lot about personal finance, investing and all things money. And if you want to see more great content, please click the subscribe button below.
This is moneyunshackled.com. See you next time.